Hello value investors, thank you for joining me. Today I want to talk about uncommon investing for uncommon profits. So I've taken that title with a reference to Charlie Munger's assertion that common sense is really uncommon sense. So if you're new to the channel, please subscribe now so you can get my next value installment. Also, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns, and you can do a free trial to see if it suits you. I tell you which stocks I own and why, with a balanced argument for them. So let's get started. I see a lot of investors passionately focused on investment rhetoric, totally absent of reality. So it's this discrepancy of rhetoric versus reality that I want to talk about. So if you're investing in a company and the main thesis that you can bring to the table is talking about all the services or products that the company does, that's not going to cut it. And it's very important that your thesis is not reliant on you repeating the 90-second elevator pitch that management is putting to you. I write a lot on Seeking Alpha, and a lot of the times in the comments section I just see people pretty much repeating word for word what the CEO, what she or he may have said in an interview in a financial media outlet. That is not a strong investment thesis. Dig around and see within its financials really what you get in, because if a company is right now growing hypothetically at about 25% to 30%, not many companies are able to do that for a prolonged period of time. That's the brutal reality. So if you're paying a very large multiple, sentiment is very high, a lot is priced in, you got to dose that with a bit of reality. The next thing I would say, not all revenue is high quality. Some of that revenue can be consulting fees, onboarding of customers that they charge a small upfront fee, and that there's a lot of costs that go with that revenue. So there's not a lot of value in that, and sometimes quite difficult to see because the companies can be quite opaque, and everyone is very much focused on that revenue growth rate, and you don't double click and you don't see what's actually underneath, because there's a lot of non-GAAP accounting and there's really an abuse of that at the moment. So if you don't understand how much of that revenue could in time carry XYZ margins, it's very difficult to build a case. I see that a lot in, let's say, in software as a service businesses, and I've got a video about software as a service, but just more overarching, it's about having a bit of reality when it comes to investing, because to use our phrase of animal spirits, in 2020 there is a lot of that, and it's an illusion to believe that the markets go up at 15% year over year for a prolonged period of time. It's an absolute illusion. And if the economy is not supporting the company's growth, it's very, very difficult. What's more, with a lot of younger companies, if they're already fizzling out that revenue growth rate, and you can see that 2 years ago it's approximately 40%, and it dropped last year to, let's say, at the end of 2019 when it was coming to about 30%, and now it may be going into, let's say, 26% or even a bit lower, 25%. So you see this very steady decline, and we haven't even reached a lot of reporting amidst the heavy financial crisis. The crisis is a crisis out here, and we haven't seen a lot of that reporting. A lot of Q2 reporting is going to be looking at the period from April onwards. So without knowing the damage that we see in April and May, it's very, very difficult. And investors are willing to say, okay, this is a one-off. that quarter happened and people are willing to disregard that, thinking that next year's comparisons are going to all of a sudden look so much better. That's not happening. The economy is struggling. There's mass unemployment in the United States, in Europe, and if there's mass unemployment, essentially you haven't got customers spending. A lot of customers are going to hold back on their expenses, and if there's not discretionary expenses going on, it's very, very difficult for the economy to move on forward. So I'm not a macro person. I have no idea where the economy is going. But what I'm just saying is that consider individual companies. It's much easier game to figure out, okay, if you're paying, let's say, north of 100 times earnings for a company that's the growth is already fizzling out, it's going to be difficult. I think that there's a lot of high expectation and the reality may or may not conform to that. What's more, you have to consider really where that revenue is coming from, because if it's coming from a company being very, very acquisitive, acquiring a lot of other peers, that is a difficult game, because in the first instance, those acquisitions cost either to the shareholder in terms of shareholder dilution, or the company has to take on a lot of debt. If the company is over leveraged and we're going into global contraction, that is not a good situation to be in. So consider where that next growth is going to come from. Also, remember that if it's in a space that is undergoing a lot of consolidation, a very fragmented space, it could be the case that the multiples that the CEO is bidding for those companies in an attempt to empire build could be quite hot. If you're very acquisitive in 2020, if your company is very, very acquisitive in 2020, it's a difficult situation to be. We're just talking about aligning the investors' expectations and aligning the result that can come out. Essentially, when it comes to investing, you're deploying your savings today for what in 3, 4, 5 years down the road could be worth more. Because anything that you hold in less than, let's say, 2 years is just a speculation, just taking a punt. So I'm not a particularly risk-averse investor. I just learned to be a bit sensible. I'm just trying to say, okay, we got to be mindful of what we're acquiring, and if the company that you're investing in, you're very firmly aligning yourself with the CEO and say, okay, I believe that the CEO is amazing, is remarkable, and then you pitching a load of rhetoric and coming out and saying, I believe that the CEO will somehow figure this out. That's not a good position to be in. In my mind at this moment in time, I'm thinking of something like Salesforce. I have no position in Salesforce, and I know that there are a lot of very good investors that are invested in Salesforce, and they'll say, oh, Michael, you totally got this wrong. It is possible that I've got this wrong. It is certainly possible. But these are so many different companies that are in that bucket, and it's very, very difficult because that is specifically in the cloud sector, it's very, very competitive. But it's not just the cloud sector. You look up and down tech. If you disregard the highfalutin, high-flying tech stocks, underneath that, the rest of the market is really not performing that well. So you can't have this discrepancy. It's not that tech is going to be fine because everyone is digital, low-touch economy. You have to have a bit of common sense when it comes to investing. And I see that a lot of investing nowadays comes from investors that haven't really spent a lot of time studying crashes. I have another video about talking about a book called 5 Crashes by Scott Nations, and you can see that if you spend a bit of time just studying financial history, when the crashes come, it is visceral, and there's not a way to say, okay, I think the things are going to be okay and I'll predict when to get out. It's very, very difficult because it's like that, particularly nowadays with a lot of A, stop losses, B, algos. It's very, very difficult. So and what happens is that when you get out of your business and you sell that business and the business goes down further, there's that emotion coming against you. So you have to overcome the emotional bias, because in that instance where the share price continues to fall, you should be able to say as an investor, I like that business when it was high. When it's cheaper right now, it's more compelling, it's more attractive. But what actually happens emotionally, we get that bias, we get that wall, and we think to ourselves, okay, it's a good job I sold that business. I don't want to be involved in that business. That business is selling off, but it's a good quality business. And it was a good quality business when that person owned it much higher. So you have to put in your mindset, write down, I always say, write down 2 or 3 reasons why you want to own that business and have a long-term horizon on it. But dose it with a bit of reality, and don't have the whole investment thesis reliant on just spinning back what is the key service or the key product that the company does. Have a bit of common sense. Don't try and pay more than 100 times earnings, or even be very, very careful of those companies that have absolutely no earnings at all. Be very, very careful, because everyone at the moment is playing that kind of FOMO game, fear of missing out, and it's very, very difficult, and that's just an illusion. I haven't done this to this extent, but you see Warren Buffett is really taking his foot off the gas. He's saying, okay, I am willing to sell airlines at a loss just so I can have a bit of a war chest, because this is looking very grim. Now, many people say, oh, Warren, he's lost his touch. And I'm saying, I wouldn't count him out. This person's been investing since he's 11 years old. He's probably got 70 years of experience, which is much more than most investors. It was at the time the richest man in the world. He's been through a lot of these booms and busts, and he's seen a lot. And when you've summed up all that capital, it has to come from somewhere. It has to come from hard learning experience and being able to reflect a lot. It's what Charlie Munger says, that the biggest advantage Warren has is that he's a learning machine. So I hope you found this video useful. Please measure the reality against the rhetoric. Come over with my marketplace. Check out which stocks I own and why. I offer balanced arguments for my stocks I own. Do a free trial there, and I'll see you next time.